Something extraordinary just happened in the silver market, and I'm not talking about the price moving up a few dollars. I'm talking about a structural shift that hasn't occurred in over 40 years. The kind of signal that, historically, has preceded the most explosive moves in precious metals history. And if you're not paying attention right now, you're going to miss what could be the opportunity of a lifetime. Let me show you exactly what I'm seeing, because this isn't speculation. This is data. This is positioning. This is the kind of market setup that traders dream about, but rarely see in their entire careers. The signal I'm referring to showed up 3 weeks ago in the COMEX futures data. The commercial short position, the big banks and institutions that typically suppress silver prices, just hit its lowest level since 1982. Think about that date for a moment. 1982. That was right after silver's legendary run to $50 an ounce in 1980. The Hunt brothers squeeze. The most famous precious metals move in modern history. And we're seeing similar positioning right now. But here's what makes this even more significant. Back in 1982, the commercials were covering their shorts after the price had already exploded. They were getting out of the way of a freight train. Today, they're covering before the major move has even started. Silver is sitting around $30, not 50, not 40, 30. Which means if history rhymes, and it usually does in commodity markets, we're not looking at the end of a move. We're looking at the beginning. Now, I know what you're thinking. You've heard bullish silver calls before. Everyone's always saying silver is about to explode. It's become almost a joke in financial circles. The boy who cried wolf of the investment world. But this time is genuinely different, and I can prove it to you with multiple data points that have never aligned like this before. Let's start with the physical market, because that's where the real story is unfolding. The United States Mint just reported something shocking. Silver Eagle sales in the first quarter of this year exceeded the entire annual production of several major silver mines combined. We're talking about retail demand alone absorbing what would normally supply industrial users for months. And this isn't just happening in America. In India, silver imports hit a record high last month. In China, the Shanghai Gold Exchange is seeing silver withdrawals at levels that suggest institutions are taking physical delivery at a pace we haven't witnessed since the 2011 run. In Germany, silver coin premiums are running 15 to 20% above spot price. When you have to pay 20% more than the official price just to get your hands on physical metal, that's not a normal market. That's a shortage trying to reveal itself. But the mainstream financial media isn't talking about this. They're focused on the paper price. The spot price you see on your screen, which is determined by contracts traded on the COMEX in New York. Contracts that represent silver that mostly doesn't exist. It's a beautiful system if you're a bank trying to control prices. You can sell unlimited paper contracts without ever having to deliver the actual metal. It's worked for decades, until it doesn't. And right now, we're seeing cracks in this system that suggest it's about to break. The COMEX silver inventories, the actual physical silver sitting in registered vaults available for delivery, has dropped 42% in the last 18 months. At the same time, open interest, the number of contracts claiming ownership of that silver, has increased. You don't need to be a mathematician to see the problem here. More claims on less metal. It's musical chairs, and someone's about to be left standing when the music stops. Let me give you some context on why this matters so much. Silver isn't like gold. Gold is primarily a monetary metal. Central banks hold it. Wealthy individuals hold it. It sits in vaults. Silver is different. Silver gets consumed. It goes into solar panels and never comes back. It goes into electronics and gets thrown away. It goes into medical applications and disappears. Roughly half of all silver mined each year is used up in industrial applications and never returns to the market. This creates a unique dynamic. When investment demand surges, as it's doing right now, it competes directly with industrial demand. And industrial demand isn't optional. You can't build an electric vehicle without silver. You can't manufacture solar panels without silver. You can't produce smartphones or computers or 5G infrastructure without silver. These industries need it, regardless of price. So, what happens when investment demand spikes at the same time industrial demand is hitting record highs? You get a squeeze. A real, physical squeeze, not the paper manipulation we've seen for years. And that's exactly what's setting up right now. The solar industry alone is projected to consume over 200 million ounces of silver this year. That's roughly 20% of total global mine supply. Electric vehicles are adding another 50 million ounces of annual demand. 5G infrastructure, another 30 million. These aren't small numbers. These are structural demand increases that aren't going away. In fact, they're accelerating. Meanwhile, silver mine production is essentially flat. We're not discovering major new silver deposits. The easy silver has been mined. What's left is lower-grade ore that costs more to extract. Several major silver-producing countries are seeing production declines. Mexico, the world's largest silver producer, saw output drop 8% last year. Peru, number 2, down 6%. These aren't temporary disruptions. These are geological realities. Now layer on top of this the investment demand that's starting to wake up. Silver ETFs saw their first significant inflows in 3 years last month. Retail buying is surging. But here's the really interesting part. Institutional money hasn't even shown up yet. The big hedge funds, the pension funds, the sovereign wealth funds, they're not in silver right now. Their allocation to precious metals is near historic lows. But that's changing. And when institutional money decides to move into a market as small as silver, the price impact is enormous. The entire silver market, all the silver that trades in a year, is smaller than the daily trading volume in Apple stock. Think about that. One tech stock has more liquidity than the entire global silver market. So when real money decides to allocate even a small percentage to silver, there simply isn't enough supply to meet that demand without massive price increases. I want to tell you about something that happened in 2011, because it's instructive for what we might be about to see. Silver went from $18 to $49 in less than 4 months. It wasn't because of some fundamental change in the market. It was because investment demand suddenly surged, and there wasn't enough physical metal to meet it. Premiums exploded. Delivery delays stretched to months, and the price nearly tripled in a matter of weeks. But here's what most people don't remember about 2011. The move didn't start when silver was cheap. It started when silver was already at $18, which at the time felt expensive. People were saying it had already run too far, that it was overbought, that you'd missed it. And then it tripled. The setup today is actually more bullish than 2011. Back then, we didn't have the industrial demand story we have now. Solar was a tiny industry. Electric vehicles barely existed. 5G wasn't even a concept. The demand was primarily investment-driven. Today, we have both. We have structural industrial demand that's growing exponentially, and we have investment demand that's just starting to wake up. And here's something that should terrify anyone short this market. The short interest on silver mining stocks just hit a 10-year high. Hedge funds are massively short silver miners, betting that the stocks will fall. This is the same setup we saw before the GameStop squeeze, before the Volkswagen squeeze, before every major short squeeze in market history. You have a concentrated short position in a market with limited supply and rising demand. It's dynamite waiting for a match. Speaking of mining stocks, let me show you something fascinating. The average silver mining company is currently trading at a valuation that implies a silver price of $22. Silver is at 30. These stocks are pricing in a 25% decline in the metal, but their costs are rising. Energy costs, labor costs, equipment costs, all going up. Which means at current stock prices, the market is essentially saying these companies are going to be unprofitable soon. That's absurd. These companies are generating record cash flow. They're paying down debt. They're increasing dividends. And yet their stocks are trading like silver is about to collapse. This disconnect doesn't last. Either silver falls to $22, which seems unlikely given the physical market dynamics I just described, or these stocks are about to re-rate significantly higher. Now, I want to address something important here, because if you're thinking about your financial future, about retirement, about protecting wealth in an increasingly unstable world, this matters. We're living through the greatest monetary experiment in human history. Central banks have printed more money in the last 5 years than in the previous century combined. The dollar's purchasing power is eroding in real time. Your savings, sitting in a bank account earning 3%, while real inflation runs at 8 or 10%, is losing value every single day. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical precious metals into your retirement account without tax penalties, how the process actually works, what the costs are. Worth checking out if that's relevant to your situation. Because what we're talking about here isn't just about making money on a trade. It's about preserving purchasing power through what's coming. Anyway, back to why this silver signal matters so much right now. We're seeing a convergence of factors that rarely align. You have the technical setup with commercial shorts at 40-year lows. You have the physical shortage developing in real time. You have industrial demand hitting records. You have investment demand starting to accelerate. And you have a macro environment where faith in fiat currencies is eroding globally. Let me tell you what's happening in the currency markets, because it's directly connected to this. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create an alternative to the dollar-based system. They're not hiding this. They're announcing it at summits. They're signing agreements. And every one of these agreements involves gold and silver as settlement mechanisms. China just announced they're going to start pricing oil contracts in yuan backed by gold. Russia is selling natural gas for rubles backed by gold. Saudi Arabia is in talks to accept yuan for oil sales. This is the petrodollar system unwinding in real time. And when the petrodollar goes, when the world stops needing dollars to buy oil, what happens to demand for dollars? It collapses. And what happens to the value of dollars? It collapses. And what happens to the price of real assets like silver? It explodes. This isn't conspiracy theory. This is monetary history. Every fiat currency in history has eventually failed. Every single one. The dollar has lost 98% of its purchasing power since the Federal Reserve was created in 1913. It's not a question of if the dollar loses more value. It's a question of how fast. And the speed is accelerating. Look at what happened in 2023. The Fed raised interest rates at the fastest pace in 40 years. They were trying to fight inflation by making money more expensive. And what happened? Regional banks started failing. Silicon Valley Bank, Signature Bank, First Republic, all gone. The Fed had to step in with emergency lending facilities. They had to backstop the entire banking system. They printed hundreds of billions of dollars to prevent a complete collapse. So let me ask you this. If raising rates caused banks to fail, what do you think happens when they have to start cutting rates again? Because they will. They have to. The government can't afford high interest rates on $35 trillion of debt. The interest payments alone are now exceeding defense spending. It's unsustainable. They're going to cut rates. They're going to print more money. And when they do, precious metals are going to absolutely explode. But here's why silver specifically is so interesting right now. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is currently around 85 to 1. Historically, that ratio has averaged around 60 to 1. In times of precious metals bull markets, it's dropped to 30 to 1 or lower. In 2011, it briefly touched 32 to 1. What does this mean in practical terms? It means silver is undervalued relative to gold by a significant margin. If that ratio simply reverts to its historical average of 60 to 1, and gold stays where it is around $2,700, silver goes to $45. That's a 50% gain from current levels just from the ratio normalizing. If we see a real precious metals bull market and the ratio drops to 40 to 1, silver goes to $67. More than double from here. And that's assuming gold doesn't go higher. But gold is breaking out to new all-time highs. Central banks are buying gold at record pace. The World Gold Council just reported that central banks purchased over 1,000 tons of gold last year, the highest level since 1967. These aren't small countries. China, Russia, India, Turkey, Poland, all massively increasing their gold reserves. They're diversifying away from dollars. They're preparing for a new monetary system. When central banks are buying, you should be paying attention. These institutions have access to information and analysis that retail investors never see. They're not buying gold because they think it's going to go up 10%. They're buying gold because they know the current system is unstable. They're buying insurance against monetary chaos. And if gold is insurance, silver is insurance that pays you. Because silver has that dual nature. It's a monetary metal like gold, but it's also an industrial metal with growing demand. You get the monetary premium plus the industrial demand. It's the best of both worlds. Let me paint you a picture of what happens when this really gets moving. We saw a preview of it in early 2021 with the Wall Street Bets silver squeeze attempt. Retail investors on Reddit decided to try to squeeze silver. They bought physical. They bought SLV shares. They bought mining stocks. And in a matter of days, silver jumped from $25 to $30. Premiums on physical silver coins went from $3 over spot to $15 over spot. Dealers ran out of inventory. Mints couldn't keep up with demand. And that was just retail investors on one internet forum. Imagine what happens when institutional money shows up. When pension funds start allocating. When sovereign wealth funds decide they need precious metals exposure. When the ETFs see sustained inflows instead of one-week bursts. The market simply cannot absorb that kind of demand at current prices. The float of available silver is tiny. Most silver is locked up in industrial applications or jewelry or silverware. The amount available for investment is maybe 2 billion ounces globally. Sounds like a lot until you realize that's only $60 billion worth at current prices. Apple's market cap is $3 trillion. One company is worth 50 times the entire investable silver market. When real money moves, silver is going to gap higher in ways that shock people. And we're already seeing the early signs. The bid-ask spreads on silver are widening. That means there's less liquidity, fewer sellers willing to part with metal at current prices. Delivery times are extending. Premiums are rising. These are all symptoms of a market that's tightening, of supply struggling to meet demand. Now, I want to talk about something that most analysts are completely missing. The energy transition that governments around the world are mandating requires absolutely massive amounts of silver. The International Energy Agency estimates that achieving net zero emissions by 2050 will require silver demand from solar panels alone to increase by 400%. 400%. Where is that silver going to come from? Mine supply is flat. Recycling can't keep up because most silver in electronics is uneconomical to recover. The only way to incentivize more supply is through higher prices. Much higher prices. We're talking about silver needing to trade at $50, $60, maybe $70 an ounce just to bring enough supply online to meet the projected demand from the energy transition. And this isn't optional. Governments have mandated this transition. The European Union, the United States, China, all have legally binding commitments to increase renewable energy. Solar is the fastest growing segment. Every solar panel requires silver. There's no substitute that works as well. You can't just decide not to use silver and still hit your renewable energy targets. This creates a fascinating dynamic. Governments are essentially mandating higher silver prices through their energy policies. They just don't realize it yet. But the market is starting to figure it out. That's why you're seeing smart money quietly accumulating. That's why the commercial shorts are covering. That's why the setup is so explosive. Let me tell you about a conversation I had with a mining executive last month. He runs one of the largest silver mining operations in Mexico. I asked him what silver price his company needs to justify expanding production. He said $60. At current prices, they're mining their existing reserves, but they're not developing new deposits. It's not economical. The permitting takes years. The capital costs are enormous. The environmental regulations are strict. Unless silver is sustainably above $50 or $60, they're not investing in new supply. And he's not alone. I've heard similar numbers from executives at other mining companies, which means the supply response to higher prices is going to be delayed by years. Even if silver goes to $50 tomorrow, it takes 3 to 5 years to bring a new mine online. During that time, the deficit between supply and demand just grows. The shortage gets worse. The price has to go higher to ration demand. This is the opposite of what happens in most commodity markets. Usually, high prices bring on new supply relatively quickly. Oil rigs can be deployed in months. Copper mines can ramp up production. But silver is different. It's mostly a byproduct of other mining operations. Only about 30% of silver comes from primary silver mines. The rest comes from lead-zinc mines, copper mines, gold mines, which means silver supply is largely dependent on the economics of other metals. And here's the kicker. Many of those base metal mines are struggling. Copper grades are declining. Lead-zinc operations are shutting down due to environmental concerns. which means even if silver prices rise, the supply response might not materialize because the mines that produce silver as a byproduct aren't economical for their primary metals. We're heading into a perfect storm. Demand is surging from multiple directions. Supply is constrained and can't respond quickly. Inventories are depleting. The paper market is showing signs of stress, and the macro environment is screaming for hard assets. I want you to think about what happened in the 1970s, because there are eerie parallels to today. In 1971, Nixon closed the gold window. The dollar was no longer backed by gold. It became a pure fiat currency. What followed was a decade of inflation, currency debasement, and a massive bull market in precious metals. Gold went from $35 to $850. Silver went from $1.50 to $50. Today, we're in a similar situation, but on steroids. The money printing in the 1970s was nothing compared to what we've seen since 2008. The debt levels were manageable then. Today, we have debt-to-GDP ratios that would have been considered impossible 40 years ago. The financial system is more leveraged, more fragile, more dependent on central bank intervention. And just like in the 1970s, the initial response to inflation was to raise interest rates. Paul Volcker raised rates to 20% to break inflation. It worked, but it caused a severe recession. Today, the Fed can't raise rates to 20%. The government would default. The banking system would collapse. The economy would implode. They're trapped. They can raise rates enough to slow things down, but not enough to actually stop inflation. Which means inflation is going to persist, and precious metals are going to continue their bull market. But here's what's different this time. In the 1970s, most people didn't own precious metals. It was a niche investment. Today, awareness is much higher. Information spreads instantly. When this move really gets going, when silver starts making new highs, when it breaks through $50 and heads toward the old inflation-adjusted high of $150, the FOMO is going to be intense. Everyone's going to want in. And there's not going to be enough supply to meet that demand. The premiums we saw in 2021 are going to look quaint. We could see premiums of 50% or more over spot. We could see delivery delays of 6 months or a year. We could see the paper market completely disconnect from the physical market, with physical silver trading at massive premiums to the COMEX price because the COMEX price is fake. It's based on contracts that can't be delivered. And when that happens, when the paper market breaks, the price discovery is going to be violent. We could see silver gap up $10 or $20 in a single day. We could see trading halts. We could see exchanges change the rules to protect the shorts. We saw all of this in 2011, and the setup today is even more extreme. So what does this mean for you? It means if you've been thinking about silver, if you've been watching from the sidelines, if you've been waiting for a pullback, you might not get one. The signal the market just gave us, the commercial shorts at 40-year lows, that's not a signal to wait. That's a signal that the smart money is positioning for what's coming. And when the smart money is moving, you want to be moving with them, not against them. This is the kind of opportunity that comes along once in a generation. The last time we saw a setup like this, silver went from single digits to $50. The time before that, it went from $1 to $50. The pattern is clear. When silver breaks out, it doesn't move 10 or 20%. It multiplies. And we're sitting right at the beginning of what could be the biggest move yet. The fundamentals have never been more bullish. The technical setup has never been more explosive. The macro environment has never been more supportive. Everything is aligning. The question isn't whether silver is going higher. The question is whether you're going to be positioned when it does.